Okay, there we go. All right. All right. So good evening, everyone. My name is Davon Reeves. I am the CEO of Vestor, which is a commercial real estate crowdfunding platform. And for the next couple of days, we're going to talk about retail and how you can get into retail. And a lot of folks are probably like, wait, what is retail? What does that mean? I don't know. So that's why we're having that to introduce y'all big on education, engaging, and invest. So do me a favor, put in the chat, let me know where y'all from. Let Miranda know where y'all from. Tonight, Miranda is going to talk about commercial real estate and retail, how to get into retail, the different types of commercial real estate and how retail is a component of it. Tomorrow, I'm going to talk about Vestor and talk about the different ways that you can fund your investments through Vestor. And I mean, on Vestor on the platform. And then the last day, Miranda is going to talk about investment opportunity that she has on Vestor. So I'm going to go ahead and be quiet and pass the baton over to Miranda. You should be able to share your screen. And thank you all for tuning in. And also, if you have any questions, feel free to put it in the Q&A.
Hey, everybody. Can you hear me okay? How are you? All right. Tonight, we are going to talk about how to buy a shopping center. I know many of us have seen, the retail all around us every day. And in a lot of cases, we have just been bystanders to what we see in our neighborhood. And so I want to take tonight to just really explain to you guys about retail, about shopping centers, how they work, how they fit into the grand scheme of commercial real estate. And hopefully you'll walk away having learned more about this asset class, is what we call it. So I'm going to start at a very, very, very basic level. So please bear with me if these are all things that you're already familiar with. And then at the end, we'll hold for questions if anybody has more higher level questions about investing in this asset class. So we'll start from the beginning. The types of, I am the CEO, I didn't even introduce myself. I am the CEO of Genesis Development Partners. And we are a development firm that specifically works in new construction of retail shopping centers. We work with tenants who are looking to build new stores, and we purchase the land usually at their request and build the store for them. So with that being said, let's go ahead and jump into the presentation. We're going to start with talking about the types of real estate that are out there. And if people who are, looking to invest in real estate or even work in real estate, all of this categories and vocabulary is important for you to know. So when you're having a dialogue with someone in the industry, you will be able to see things how they see it, and you'll be able to have intelligent conversation about real estate outside of what you may know about your personal real estate. So to break that down, really, we have two major classes: real estate. Of course, most of us are already familiar with residential real estate. You guys, most of you know a local residential real estate agent, or you've purchased a home, or you've even invested in residential real estate. Of course, this includes homes, townhomes, and condos. And then we're into this world where I have spent the last 25 years of commercial real estate. And this is any real estate that's zoned and used for commercial purpose. Of course, this includes office buildings, industrial, and retail. Those are the major categories of that. Office properties, we pretty much know what that is. It hosts operations. It can go from small single-story buildings to, huge skyscrapers. Retail properties, which will be our focus tonight, are designed for any business that sells goods and services to the public or from business to consumer. Industrial properties are usually large warehouses or factories where goods are manufactured and stored, and then of course, mixed use properties. When you are dealing with any type of real estate professional, usually they will niche down in one of these categories. So that's why it's important for you to understand what the categories are. Now, when we're speaking about retail, it's one of the largest, most diverse categories within the commercial real estate sector. It holds about approximately 25% of commercial real estate market share. Over the last decade, the industry has experienced 4 to 5% annual growth, with net commercial and retail square footage continuing to climb. And we'll talk about that in a minute, because you're seeing different aspects of retail real estate go through a major transition, but there are some areas that are continuing to grow. Retail real estate leases are usually a minimum of 5 years, and they derive their value from the rent of the tenants. We all know real estate is about location, 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 of course, right? But the value of a retail asset is determined by the rent of the tenant. It's by how much the tenant is paying, the credit of that particular tenant, meaning how well respected is their word, how well respected is their lease. I mean, how many of us know that getting a lease from a company like Walmart is different than getting a lease from a local hair salon? If I received a lease from Walmart, I would assume that they would do whatever they said they were going to do. And if they didn't, they would pay me. I'm sort of banking on the success of that particular store doing well enough that even if they needed to exit the market, they could still adhere, which is laid out in that lease. If I'm Walmart, I have way too much to lose to stiff you in your lease. It's better for me to pay you and maintain my reputation so that I could do additional business across the country. So that's what I mean when I say the credit of the tenant. There are different avenues that rate that credit, such as Moody's and other things. So when you are leasing space to a tenant, you can look up on the scale of what the credit of that particular tenant is. And that can help you kind of determine the level of risk that you are taking with putting that tenant in your retail shopping center. And then you can determine all the other lease terms. And it's very, very, very important, because the value of your shopping center comes from the rent of the tenant, including several factors: that tenant's credit, the length of the lease, the amount of the rent, and the basic rent terms of the lease. All right, now there are different types of retail. I think most of you guys probably instinctively know this, because these are all things that you personally experience. But I'm just going to kind of break it down to you, because these are the things that are important when you start looking at what asset class you want to invest in. And so let's start with a mall. Everyone knows what a mall is. It's usually something that's 400 to 1 million square feet of space laid out on 60 to 120 acres. Usually malls are what we would call regional and super regional centers. The reason why that's important or even noted is that basically describes how far will people drive to get to this particular destination. So that's what determines a lot of times what shopping center asset class it is how far will people drive to get to that particular destination. And so for malls, that is the largest driving distance, or what we call in the industry trade area, is how far people will drive to get to that particular place. So for example, if I live in a market where there's a mall 5 miles away or 10 miles away, if they're a particular collection of tenants, I may be willing to make that drive. Whereas I probably would not drive 10 miles to get to a grocery store or 10 miles to get to a Starbucks. So that helps you kind of understand the difference in trade area and distance. The next thing is a lifestyle center. And you guys have probably seen these. These were invented. And the example of a lifestyle center is what you see in the top right-hand corner, where you have sort of higher end retailers. It's an outdoor center. It's typically centered around dining or entertainment. A lot of times there's a movie theater, outdoor eating, and things like that. Lifestyle centers were invented to assist as malls started to die out, to still have a place for shoppers to go. People were looking to be more outdoors and enjoy the city more. Next, power centers. It's almost like you can see a power center and it's almost the same with the same tenants in every single city. That would include big box retailers such as Lowe's, TJ Maxx. It's usually a long list of characters, Kohl's and things like that. Those are what you call a power center. These retail centers are typically leased to discounters, home improvement retailers, and large specialty chains. The power center is what you're seeing having some issues right now, because big box stores are what we call category busters, meaning like you're seeing Bed Bath & Beyond right now beginning to close their stores. That's a classic example of a big box, where they've taken one category and focused completely on that category and specialized in it, which worked fabulously 20 years ago. But with the invent of online shopping and things like that, it's making it challenging. So you have these centers that range from 250,000 to 600,000 square feet. And you're starting to see a lot of vacancy for these larger stores. We saw a wave of it, maybe 10 years ago, when stores like, Borders going out of business. You're seeing it now. So we'll see who's left at the end of that, this next wave. Next is the area that I really like to play in. I stay away from malls. I stay away from lifestyle centers. I stay away from power centers. I like neighborhood centers. Neighborhood centers serve the immediate needs of a population. They're typically grocery anchored. Their trade area is typically 3 miles. They're smaller. And so neighborhood centers is what you see that's typically anchored by, Publix or a Safeway, Albertsons, or a Kroger. Now, most of the deals that I do right now are right in this space, what I call a convenience center. It's non-anchored or anchored by a smaller tenant. It is usually centered on goods and services for the immediate area. It is usually less than 30,000 square feet. My sweet spot is 15,000 square feet or smaller. The reason why is those are the retailers that are continuing to thrive and expand and basically offer services that you cannot purchase online. Right? So I'm not experiencing the same competition as, let's say, a Dick's Sporting Goods, where someone may walk into Dick's Sporting Goods and try on the shoes, but then go home and wait and see if it's going to go on sale online. You can't do that with a cup of coffee. And it's a lot harder to do that with a prescription or just basic services that you would need day to day. A lot of times people aren't going and price shopping for those things. They're grabbing it as a matter of convenience and as a matter of a necessity for their day-to-day lives. I kind of went over this a little bit, but why I like to focus on neighborhood and convenience centers. Number one, they are smaller in scale. It is a much lower occupancy cost. So what I mean by that, when you go into a mall, and you have these huge floors and you've got bathrooms and you have service corridors and food courts, all of that is very expensive. You have to pay someone to do everything for this larger space. Whereas with a neighborhood and convenience center, everything is smaller parking lot, less lighting, less sidewalks, absolutely no interior space. And so your occupancy cost is lower. That's what I mean when I say occupancy cost. The smaller tenants tend to pay higher rents per square foot. So an example, in a large power center, you'll see some of those tenants pay, $6, $7 a square foot, whereas, or sometimes upwards of 10 to 12, but whereas in a smaller neighborhood center, you're going to get something more like $25 to $35 a square foot. So my net per square foot is higher on the smaller tenants. Number three, I could pass my operating taxes and insurance costs onto the tenant. That is a term that is called triple net. So the three N's, that is what I am passing on to my tenant. So my tenant will pay their rent. They will also pay their fair share of the operating cost. So if it's up in New England and I got to bring out a snowplow 4 times a year, I will take that invoice and then split it amongst my tenants and put it into what we call their common area maintenance charges, which is one of those expenses that I pass on to them. Same thing with taxes, same thing with insurance. And so it allows me to have predictable income over time. So if you were to compare a shopping center with, say, a residential or even a multifamily unit, typically you're looking at how much rent would you collect over 12 months from individual people that have individual circumstances, versus in a shopping center, you're looking at 5 years from companies who you can really evaluate their track record, because typically they are publicly traded. Does that make sense? So you have long-term leases and stability that will usually allow you to have predictable cash flow. Once you combine that with the understanding that you're able to pass your expenses on to your tenants, you're able to draw a pro forma that is quite consistent, if that makes sense. So those are all reasons why I like to focus on the neighborhood and communities. They tend to be a lot less sensitive to economic downturn. COVID, no COVID, people are still getting their prescriptions. They're still picking up their coffee. They're still, grabbing a drink on their way somewhere. These are things that still happen even when you have economic downturn or changes, cultural or any type of unexpected change in the market. Whereas you'll see other asset classes and other types be quite sensitive to those things. Community and neighborhood centers are less impacted by e-commerce. We talked about that some. And then lastly, these centers have a really diverse mix of tenants. They tend to include grocery stores, pharmacies, medical offices. So sometimes you'll see retail dentists that, is a chain of dentistries. They provide the essential services of the community. So these are things typically that people are unwilling to go without and appreciate the convenience of it being close to their neighborhood. In fact, when people are looking to purchase a property, a home, a lot of times they want to make sure, where is the nearest grocery store? Where is the nearest pharmacy? All of these things equate value to the average person. And so as a shopping center developer and/or a shopping center investor, you're able to provide essential goods and services to neighborhoods that are very, very valuable to people and that are very valuable to those neighborhoods. All right. So this slide just kind of breaks down some of the things that we've already talked about throughout this presentation. I just wanted to do something that kind of called it out. And I don't want to take up too much of your time, so I'm keeping it very brief. But the reasons to invest in shopping centers versus maybe any other investment, and versus any other real estate investment. Number one, the tenant leases are typically 5 years or more, okay? Very rarely will you find a retail lease that is less than 5 years. So again, we talked about it before, predictable cash flow. Number two, the credit from the national tenants is what actually adds value to the center. So it is based on location, but the thing that determines the value as it relates to location is the rent. Really, the value of commercial real estate is based on how much rent you are collecting. It is a direct factor. We use things called cap rates that literally determine the value. It is not, it is very subjective, not objective, like a home. A home, a lot of times will say, oh, it's got a great bathroom, so it's worth more. Or it has, wonderful yards, so it's worth more. Commercial real estate is not like that. It is directly connected to the rent. The cap rates are usually, and the cap rate is the relationship, the measurable relationship between rent and value. And those are determined in the market, and then we basically use that to determine the value. So again, the value of the center is connected directly to the national credit tenant. And in our case, a lot of times we are working with that national credit tenant before we even evaluate a deal. We talked about this, tenants pay the expenses, you literally pass those through to them. And shopping centers can be quite inexpensive to operate for that reason, because we're passing through common area maintenance, which we talked about. The example of common area maintenance is the snow plow, or the lights in the parking lot, or any repairs you would need to do to the parking lot or sidewalks. Typically in a shopping center, your lease will say that the landlord is responsible for all exterior walls for the space. So everything from the interior wall in is the responsibility of the tenant. So they're not calling us and saying, oh, my toilet needs fixing, or a light came out, or there's an electrical issue. All of those things are the responsibility of the tenant. We would be responsible for exterior things, such as anything with the building. The roof, typically we will allocate what we call a reserve for the roof, or any other major things like parking lot repavement or things of that nature. Is all included in our pro forma. So for example, if you were in your house and you know that you replace your house roof every 15 years, you maybe would say, you know what, I'm going to allocate $1,000 a year because I know in 15 years I'm going to need to replace this roof. That is what a reserve is. And so we allocate that in the very beginning when we are doing a pro forma on building the shopping center or purchasing it. And the final thing that we haven't talked about yet is another reason why I like smaller centers is because there are many, many buyers who can purchase the center should we want to exit. So it's not a situation where we are stuck with that asset because we can't find a buyer and it's sitting on the market. Typically, there's a lot of money that chases these types of deals. There is a concept called a 1030 exchange. And what a 1031 exchange is let's say you purchased a house and you were going to sell that house and you were going to make, say, $500,000. If you were to take that money as income, you would pay taxes on it. You actually have a right within, I don't remember the amount of time, that you could roll that money over to another piece of real estate and not pay taxes on it right away. So a lot of times you'll have a high demand, especially for shopping centers that cost $5 million and less, of people with these 1031 exchange dollars that are wanting to have all the benefits we talked about in this presentation by purchasing a retail shopping center, if that makes sense. So you are able to exit these a lot easier than, let's say, if I had a power center that was $50 million exit. Well, there's less people with access to $50 million than there are people with access to 5, right? So I like that asset class because there are far more buyers than inventory, especially if you have a national credit tenant, again, that people are comfortable with, that people feel like, you know, hey, this company is well known and this company pays their bills. Okay. And that is my presentation. I hope that that was very clear. Let's see, let me open up the chat and we can start taking questions. Oh, hi, Jeff. Commercial broker in Orlando. So Jeff can probably resonate with a lot that we talked about today. Can we have these slides, please? Yes, you can, Theodore. I will send them to Devon. And Marianne says, how do you buy one? So the way that you would purchase a shopping center, there's a few ways, and I know Devon is going to get into that later on in this challenge. But the main thing you want to do is to be able to understand the asset and be able to research to purchase the correct shopping center. So you want to understand what the metrics are that make sense for it, what type of return you're wanting to get, your financing, where the money is going to come from, and things of that nature. We will have opportunities with Investor for you to work with someone like me who is out developing new shopping centers, and you can be a part of that process as an investor. And then there's also opportunities where doing a deal with someone like me, then you're starting to learn what to look for, what it's like to own a shopping center, what are some of the avenues of how it works, because we'll be sharing that process with you, and you build your assets to then, Marlene, go out and purchase your own or develop your own. Is that clear, Marlene, or did you want more clarity? Okay. Are there any other questions? All right. Okay, dear, thank you. All right, are there any other questions? All right, Devon, I'm gonna pass it back to you.
All right. Go get it. Okay. Oh, let me show my face. So what did y'all think of that? That was good. Let's see. Oh, it says when and how dividends are paid to invest. Did you answer that already?
Oh, no, I can't see that one. Okay. So I'll talk a little bit about my particular business model. So my business model is where I actually work with the retailer to identify where they want to go first. Then we purchase the land on their behalf and we build their building for them. For me, I bring investors in and then I exit. I do not hold the asset. I exit, pay my investors back with a return. So in my case, I pay 1.5 times what they invested. So what that means is if you put in $10,000, you'll get back 15, right? And then you could take that 15 and roll it into the next shopping center and continue to grow. Or you could take your 15 and go to Disneyland with it. It's totally your choice. But we don't hold the assets. We will typically build and then exit. So for example, if someone who flips houses, let's say, the way they make their money is they add value to that house, whether it's changing the kitchen, whether it's, adding a second floor or improving the curb appeal. Very similarly, I will take a piece of land and improve the value by adding a national credit tenant lease. So remember, we talked about the value of retail is based on the rent that you're collecting from a tenant. So I will take a piece of dirt that is worth X, and then I'll add a credit tenant to it, and now it's worth Y. And then when I get this Y, I split that with my investors, and we move on to the next deal. Is that clear?
Right. I'll see some. How long does it take to build?
So it typically takes 24 months to build. In the process of building, the majority of that is your preparation. So if I'm working with a national credit tenant, usually it's a big company, I have to go through internal approvals with them. And what I do is I protect mine and my investors' assets by not allowing money to go hard until that internal approval has been completed, if that makes sense. So that's number one. And that process can take anywhere from 3 to 6 months of us getting internal approvals, because a company like, say, Starbucks or Walgreens is not like a person. They have to go through an actual process to say, all right, we said we wanted to be here. Now we have to go through the process before we sign the lease and get all of our internal approvals. And then once we receive those, then we begin our process of development. The next step after that would be going through the permitting and zoning process of what we call in development entitlements. So we'll go in and we'll do soil testing to evaluate the environmental ability to build there. Can we get the correct zoning? Can we get the correct permitting? We have to walk through a process with the city. And that whole process typically takes the longest of any process. It takes for us anywhere from 6 to 12 months to go through permitting and entitlements with a city, depending on where you are. A lot of times, Florida, Georgia, southeastern states can be a little bit quicker. Not really Florida, because Florida just has so much development right now. Their municipalities tend to get backed up. But when you start getting into older cities, up in, New England, some parts of the Midwest, it could take some time to get through that entitlement process. That includes neighborhood meetings, presenting to the city, presenting to the zoning board, and all of that. When you're dealing with shopping centers and you are, Martine says she's in South Florida. I'm sorry, but you can get through it. When you're dealing with shopping centers, there's plans. You have to evaluate how the water is going to run off. You have to evaluate how much of city services are you going to be using? How much sewer are you going to use? How is it going to impact DOT? A lot of times you have to do traffic studies. These are all in what we call the due diligence process. So a lot of that is what takes the longest. Once we get through that process, depending on the size of the shopping center, the time to build it can range anywhere from 120 days to 180 days, which is not even as long as going through the entitlement process. But when we're dealing with single tenant buildings, like for example, I have one up in North Kingstown, Rhode Island, that we own, and we're working with McDonald's. Okay, and McDonald's has signed a 20-year lease with us. That lease today, even without us building a thing, has value. Okay, so the moment that we begin moving the dirt around, and once that building goes up, I will have that McDonald's will be sold before it opens. As long as the building is up and people can physically see it, it will be sold before it opens. I have people waiting.
Oh shit, that's right. I
Yeah.
forgot to change that. Okay, all right, because I forgot it was a 12-week. Okay.
Oh,
Okay, I'm sorry. I'm doing it right now.
Are
Okay.
you're not
Okay,
muted
right
anymore.
now.
Sold as a franchise. So our lease is a corporate lease, Bridget. So our lease is with McDonald's itself, and yes, they will probably sell it as a franchise. But with most of our projects, we like to get corporate leases because that's what adds the highest value. So that's usually what I pursue. If it's a franchisee, let's say, who has multiple locations and has a really strong asset balance sheet, then they can come on with us typically. Because for me, it's all about what that bond rating is and what we can determine their credit from Moody's. Because remember, that is what I'm selling. I am selling the value of that lease. Jacqueline, how do you find and vet your investors? The majority of my investors are much larger investors that invest large amounts of money, but I really believe investor, and I believe in Davon and what she is doing in our community. And I feel very, very, very fortunate to have these relationships with these retailers. And I would feel remiss not offering it to people at the level that that people can participate, that more people can participate. So the vetting process goes through Vester and Davon, and she can speak more to that. But usually it's the same people that invest in everything that get opportunities to invest in shopping centers. In this case, because of Vester, it's being offered to the everyday person. How does this process get funded? Is it joint venture investment? How does credit? Okay, Kimberly, that's a great question. So typically we will have a capital stack, which is how that money is divided through equity investors and debt financing or the bank. Okay. A lot of times you could go into your community bank and meet with their real estate relationship manager. So like, let's say you found a shopping center that you liked and you went on to CoStar or LoopNet and you pulled the numbers and decided, you know what, I can get a return and I can add value. You would then walk into your community bank and talk to the real estate relationship manager and just have a conversation with them. Say, I'm a retail real estate investor and I'm looking at some real estate deals in my market. And I'd love to know, at what terms are you seeing deals right now? It changes drastically with the market, just like anything else. Sometimes you'll see them do 80-20, so meaning you'd only need to bring 20% down. Other times, like now, you're looking at 30 to 40% equity or what you would need to put down on an asset. Okay, so I think it's okay, Kimberly, to just start having that conversation. If you have a bank that you've got a great relationship with, I think it's okay for you to just sit down with them and try to understand what their terms are. Again, that would be a real estate relationship manager would be the person who you can have a conversation with. Remember, credit is important, but not as important as it is in residential. What's more important, again, is those tenants and the value of the rent. Remember, when you're dealing with commercial real estate, that relies so much more heavier on the project than it does on you as the individual. So yes, you have to have decent credit. Yes, it helps even more to have a good relationship with your financier, but they are going to be looking heavily at those numbers and heavily at the income, because the income is coming from the tenant. In your house, your income is coming from you. So they focus on your credit. In a shopping center, the income is coming from the tenant. So they focus on the tenant. Does that make sense? Business credit or personal credit? That depends on the bank, Kimberly. It depends on all the deals that I've done. I've still had to do a personal guarantee on them. Unless in one deal, I actually just brought in all cash because my investors had all cash. But you will probably still have to do a personal guarantee. Unless your business credit has a lot of assets. I hope that answers your question. Are there any other questions, Devon? Are there questions you see that I can't see?
It says, did you answer, do investors get paid after the projects are built or once the deals are inked? Did you answer that?
Yes, so the investors get paid after we sell the asset. So what that means is, like I was just explaining a project that I have in Rhode Island, and as soon as that McDonald's is built, it will be sold. You know what I'm saying? So once that McDonald's is sold, then all the investors will be paid.
Okay. All right. Okay, says what happens when a major store or center closes, vacates, and a lot is empty for 7 years? Is there an issue maybe, or is there someone holding the land?
So if there is a tenant that vacates, so for example, if we're looking at Walgreens or CVS and you drive by and you see it's closed, in most cases, they still have to pay that rent until the end of their lease, open, closed, or not. Same thing with Walmart, unless Walmart owns that land. In a lot of cases, when you see them vacant, it's because they owned it or their lease came up. So for example, if you live in Atlanta, there was a Walmart that closed on Howell Mill. They still have, I think it was like 6 years left on their lease. Somebody set a fire in that Walmart and they closed. So they still have 6 years left on their lease. They will have to pay that rent for the next 6 years, or they will have to do like a bulk payout, or pay now upfront for the next 6 years, which that landlord will then take that money and potentially subsidize the rent for a new tenant. Thank you, S. Clark Brooks. I appreciate that.
Okay, it says, how, I think you already answered this, but it says, how does this process get funded, or is this a joint venture investment, and how does the credit approval work? I think you answered that.
Yeah.
And S. Clark, we just answered yours. It says, if you purchase an existing lifestyle center or plan to push value, then sell for profit after 3 to 5 years, how are investors paid?
Oh, well, I typically don't do lifestyle centers. And I typically don't buy existing shopping centers. I usually build them myself. But if that were the case, like if I were to buy a center, it would be because I knew there was a tenant that wanted to be there and that I could add value to that center. So for example, if there were a center and it had, say, 5,000 square feet of vacancy, and I don't want to get too technical, but their NOI, or their net operating income, was 100,000. And let's say I had 2 tenants that I knew would both pay, $40,000 each, and I could change that NOI from 100,000 to 140,000, right? I would consider purchasing that shopping center at that existing value, put those 2 tenants in there, and increase the income on it, therefore increasing the value of the shopping center. Does that make sense? So that's not my business model. That's not what I do. But to answer your question, if that were the case, it would be because I had a way to add value. Same way a residential investor walks into the house and says, I could spend, $5,000 on a kitchen and add $15,000 in value on this house and sell the house and make that $10,000. Does that make sense? That would be the same way you would do a shopping center. And again, class, how do we add value to a shopping center? We add value to a shopping center by bringing more rent, by bringing more tenants, or renegotiating the rent with the tenants that are there, or the terms that are there. I had a deal a couple of years ago with a retailer, and I did an analysis of the market, of where their stores were, how their stores were doing in that market. And I basically asked them, listen, if I reduced your rent by 8%, would you extend your lease for 10 years? They said yes. So I got investors. I purchased the shopping center that they were in and had them then increase their rent for 10 years, therefore increasing the value of that shopping center by 12%. And then I sold it. Okay, so that might be a little too technical. Y'all probably like, what are you talking about? But you're always looking to add value based on your expertise in that particular market. If you know, hey, so-and-so wants to be here, they're not here, we can add value. We have any other questions?
It says, so you spoke with the tenant before purchasing?
Yes.
Okay. Okay, I think that was it. Well, thank you, Miranda, for tuning in.
Of course.
Wait, it's always one last question. Okay, it says how much you need to invest.
Sure. So our minimum investment is $5,000. And so at $5,000, you would receive $7,500 once the shopping center is built and sold. We typically hold anywhere from 24 to 36 months.
Okay, and then she's going to talk more about the opportunity that she has. Martine said, "Come get this money." Okay. And then I missed that one. It said Jacqueline said, "Awesome, thank you, Miranda." So Miranda's going to talk more about the deal that she has on Vestor on Wednesday at 7 o'clock. So make sure you're here. No, not Wednesday, Thursday at 7 o'clock. So make sure, and then tomorrow it'll be myself talking about more about Vestor, and then the different ways that you can, the different ways on how you can fund it, like, self-directed IRAs and QRP, all that fun stuff. So again, I will thank you so much for tuning in. We appreciate you all.
Thank you guys. I appreciate
everyone will get a replay. This was recorded. No problem. I'm glad that again, I'm big on education and getting you all educated and engaged and one day to invest. It's also all about, changing your mindset and just bringing opportunities to you all that normally doesn't happen to the average person. As Miranda mentioned early in her presentation, investing in your community, like owning a Walgreens or CVS or McDonald's, is often for certain type of investors. And so now's an opportunity. That's one of the reasons why I created Investor. So that way you all can take advantage of this opportunity and change your net worth and change your investment portfolio. So looking forward to seeing you all on Thursday night with Miranda, and then I'll see you all tomorrow night at 7 o'clock. And yes, everyone will get a replay of this. And if you feel some other folks may be interested, go ahead and bring them along. And there we go. Thank you all so much. Stay tuned.
Thanks, everybody. Good night.
Good night.